Welcome to the Accounting Desk. Today, we are embarking on a concise yet comprehensive journey into IPSAS 19, the standard that shapes the landscape of public sector financial reporting by providing clear guidelines for provisions, contingent liabilities, and contingent assets. Have you ever wondered how public entities achieve transparency and faithful representation in their financial statements despite the inherent uncertainty in future events? In the next 10 minutes, we'll demystify IPSAS 19, shed light on its key definitions, and explain how its principles ensure that financial statements truly reflect economic realities with precision and clarity. As we begin, let's set our objectives clearly. IPSAS 19 is designed to ensure that public sector entities recognize obligations responsibly and present a truthful financial picture. This standard requires that provisions are recognized only when a present obligation exists and when an outflow of resources is probable and can be estimated reliably. It also mandates that contingent liabilities, which represent uncertainties, must be disclosed, rather than overstated in the financial statements. Similarly, while contingent assets might hint at potential benefits, they are not recognized until the inflow of resources becomes virtually certain. Together, these principles work to fortify the integrity of public sector reporting. Before we dive deeper, let's review some essential definitions that form the very foundation of IPSAS 19. A provision, in accounting terms, is a liability with an uncertain amount or timing that arises from a past event. Unlike a standard liability, a provision carries an element of uncertainty, requiring careful estimation based on present evidence. In contrast, a liability is any current obligation arising from past transactions or events that need to be settled through the outflow of resources. Moving further, a contingent liability is a possible obligation that arises from situations like litigation or guarantees that may or may not materialize because they depend on uncertain events. And then we have the contingent asset, which in theory represents a potential inflow of economic benefits, yet one that should not be recorded in the books until it becomes virtually certain. With these definitions in mind, the playing field is set for a precise understanding of the subsequent processes of recognition, measurement, and disclosure. Turning our focus to recognition, the standard mandates that a provision should only be recognized if three important criteria are all met. First, there must be a present obligation that has been incurred as a result of a past event. Consider this. If an entity is faced with cleanup costs for hazardous waste because of past industrial activities, this forms a present obligation that may justify a provision. Second, it is essential that there is a probable outflow of economic resources to settle this obligation. Third, the amount of the obligation must be able to be estimated reliably. These criteria safeguard against the premature or inaccurate recognition of liabilities and ensure that only those obligations that truly require allocation of resources appear in the financial statements. The next step in our understanding involves the measurement of these provisions. Measurement involves establishing the best possible estimate of the expenditure required to settle the present obligation. Practitioners often draw on expert reports, historical data, and risk assessments to arrive at this best estimate. In practice, this process may require adjustments for factors such as future cash flows or changes in market conditions. For instance, if an entity anticipates future cost variations where time plays a critical role, these future cash flows are discounted back to their present value. Such discounting, when the time value of money is material, helps in presenting a more realistic picture of the obligation in current monetary terms. With recognition and measurement clearly explored, we now venture into the realm of contingent liabilities. In contrast to provisions, contingent liabilities represent situations where there is a possibility of an outflow of resources, or where a present obligation exists, but its probability or measurement is not sufficiently reliable. A classic example of a contingent liability could be a lawsuit with an uncertain outcome or the guarantee of a third party's obligations. Despite the uncertainty, while these liabilities are not recognized in the formal financial statements, they are mandated to be disclosed in the notes. This distinction is crucial. By disclosure, stakeholders become aware of potential risks without inflating the liabilities on the balance sheet. In a similar vein, contingency extends to contingent assets. A contingent asset is recognized as a potential inflow, often stemming from events such as pending litigation, where the outcome may benefit the entity. However, in line with the cautious approach of public sector accounting, contingent assets are not recorded until the inflow is virtually certain. Nevertheless, if the probability of an inflow becomes more than remote, disclosure is recommended so that users of the financial statements can factor in this potential benefit when assessing the entity's overall financial health. At this point, it is essential to consider some special topics that further illuminate the breadth of IPSAS 19. One such area is the treatment of onerous contracts. An onerous contract occurs when the cost to fulfill the contract exceeds the economic benefits expected to be derived from it. In such cases, a provision for the unavoidable cost is recognized, ensuring that financial statements reflect the inherent losses early on. Similarly, the standard addresses restructuring provisions. These are recognized only when there is a formal plan in place and when the entity has, through public communication or other valid signals, raised a legitimate expectation among stakeholders that restructuring will occur. It's important to note that these provisions include only the costs directly linked to the restructuring and not ongoing operational expenses. Another nuanced area in IPSAS 19 concerns future operating losses. These are unique because they represent anticipated losses that may occur over a period, and they should not be recognized as provisions solely on their own. The focus remains on establishing present obligations rather than forecasting potential deficits. Such clarity in treatment ensures that financial reports do not mislead stakeholders by overstating current liabilities or underestimating future risks. Having explored the recognition, measurement, and special cases regarding provisions, it becomes imperative to address the requirements for disclosures. Comprehensive disclosure is at the heart of IPSAS 19. For each recognized provision, entities must provide detailed descriptions of the nature of the obligation, the expected timing of outflows, and any uncertainties or risks regarding both the amounts and timing. Additionally, if any reimbursements are expected from third parties, these too need clear documentation explaining the extent of certainty associated with them. For contingent liabilities and assets, disclosure involves outlining the nature of the contingencies, giving an estimated financial effect where possible, and discussing the uncertainties that surround them. This detailed disclosure ensures that stakeholders, from auditors to financial analysts, are well informed about the potential impacts and risks inherent in the financial statements. As we approach the conclusion of our session, let's take a moment to revisit the journey we've embarked upon together. IPSAS 19 stands as one of the cornerstones of public sector financial reporting. Its robust framework ensures that only measurable and probable obligations are recognized, while requiring that potential but uncertain or contingent aspects be clearly disclosed. Through its stringent criteria for recognition and precise guidelines for measurement, it safeguards both the integrity and transparency of financial reporting. In summary, we have learned that provisions must be recognized only when a present obligation exists, an outflow of resources is probable, and the amount can be reliably estimated. Contingent liabilities, although not recognized in the financial statements, need clear disclosure to ensure stakeholders are aware of potential outflows arising from uncertain conditions. Similarly, contingent assets remain off the books until there is virtual certainty of future benefits, though disclosure is recommended when there is a reasonable probability of inflow. Special situations such as onerous contracts, restructuring provisions, and future operating losses further illustrate the standard's nuanced approach to ensuring that financial statements are both accurate and responsibly prepared. This approach not only enhances clarity in public sector accounting, but also instills confidence among investors, citizens, and all users of financially reported data. By ensuring that recognition, measurement, and disclosure are conducted with rigorous attention and precision, IPSAS 19 helps bridge the gap between financial theory and practical application in the public arena. As professionals, students, or individuals keen on the intricacies of public sector accounting, understanding IPSAS 19 is essential. The standard guides us in capturing the essence of financial obligations and uncertainties, turning abstract numbers into meaningful, transparent information that supports sound decision-making and accountability. In closing, remember that the clarity brought about by IPSAS 19 is not merely about meeting regulatory requirements. It's about strengthening the trust that the public places in financial reporting. Every provision, every disclosure plays a role in painting a realistic picture of an entity's financial health, ensuring that stakeholders have a solid foundation upon which to base their judgments. This understanding empowers you, as accounting professionals or learners, to apply these principles with confidence and precision in real-world scenarios. Thank you for taking this journey with us at the Accounting Desk. We sincerely hope that our explanation of IPSAS 19 has clarified its complexities and underscored its importance in modern financial reporting. If you found this session insightful, please like this video and subscribe to our channel for more in-depth analyses and educational content. Your support helps us continue to bring you clear, authoritative insights into the world of accounting standards. Stay informed, stay empowered, and we'll see you in our next session.